I'm glad we can get back on schedule ourselves. It's a May conference again. We did an interview here annually for a while, so thank you for being here, David.
I'm delighted to be with you. It's great to be with you in person. I'm glad to be back here. And I put on a tie for you because I knew you're always so dapper, and so I put on a tie this morning.
I appreciate you doing that.
I'm happy to be here with you.
I expect that from my guests, so thank you, David.
Absolutely.
Actually, it's the first chance to talk to you since the earnings, I believe. And you said something interesting in your comments. You talked about an accelerated trend towards deglobalization. In recent decades, you said we've grown used to low inflation, low rates, free flow of people and goods. I believe we're entering a period that won't be the case, and the consequences for financial markets will be meaningful. That caught my eye, David. Give me more of a take on what you meant when you said that.
Well, we've benefited enormously from global capital flows over a long period of time. And when I think about the last significant bout that we had with inflation back in the 1970s, there's no question the Fed and Paul Volcker had a big impact in unwinding that trend. But one of the big macro trends that had a big impact was the fall of the wall and really ushering in a period of decades of globalization that really brought prices down all over the world. And there are a variety of things going on in the macro that seem to be reversing those trends. And, my statement, when I hear you read it back, seems a little bit more certain than I am. I'm not certain that this trend will continue, over the next couple of decades. But at the moment, we're certainly seeing more nationalism. We're certainly seeing, because of the pandemic, a sense to think about our energy independence, our commodity independence. We're thinking about food supply chains. We're thinking about those things. And all of that has an impact to some degree on prices. And so we're in the early stages of seeing how people adjust behavior, seeing how people change supply chains, and all of that will have an impact on us.
Well, what about the global flow of capital? I mean, Goldman Sachs has benefited enormously over the last 30 years from that as well. Does that change at all as a result of some of the...
It shifts a little. In a world where there's more geopolitical uncertainty, the risk premiums that people demand to move capital around the world certainly change, and they adjust a little bit. And so, I think those changes are subtle. Whether they're long-dated and they're profound is still yet to be seen, and part of it will depend on the journey from here. How deeply rooted is inflation? What goes on geopolitically? How does the conflict in Ukraine continue to unfold? What happens in the bilateral relationship between the U.S. and China? I'd say the big thing, David, is there's just much more macro uncertainty, and that macro uncertainty certainly can affect capital flows.
Yeah, well, as can a Fed that is aggressively raising rates and reducing its balance sheet. It's not something we've seen for a very long time. Of course, we've never seen a Fed with a $9 trillion balance sheet to begin with. Is it worrisome to you? And if there is a concern, what would it be?
Well, I wouldn't say that it's worrisome. I think the Fed is appropriately focused on the fact that we've got real inflation in the economy, and their monetary policy actions are part of the toolkit to try to tame that and try to find a path to a soft landing. And that path is unclear. I think there's no question the perception of how aggressive the Fed will be in 2022 has changed over the last few months, and certainly the perspective at the beginning of January is different than the perspective today. But rates are definitely going higher. When rates go higher, it tends to have an effect on the dollar and on asset prices, and so we'll have to watch that very closely. But the path of all that and whether or not it can be navigated in a way where we kind of land softly and we don't have a serious recession is hard to predict.